So welcome to this event as a kind of internal sneak preview for members on the work that has been done through the TCFD banking pilot over the past year. And this is specifically covering the transition risk work. What we've done here is split this up into two different presentations. Yesterday, we discussed physical risk with Acclimatize. Today, David Carlin, will be taking you through the transition risk work. As far as our agenda for the day, I've decided to go a little bit deeper into the TCFD itself for this session, just with some of the thoughts around transition risk that it implies. Then, for those of you who weren't on the call yesterday, we'll do a quick recap of the banking pilot itself, with a little bit of a deeper dive into some of the outputs themselves that we didn't necessarily cover yesterday. We'll talk about the kind of three main pillars of the program itself. Those are around climate impacts and climate scenarios, methodologies and sector analyses, as well as regulation and climate risk governance. And hopefully through that conversation, you will see not only the work that's been done, the learnings that we've covered, but also in the final section, a look ahead at what is next with the new programs that we have as well. So looking forward to discussing this with all of you. And as I said, we will stop just briefly at the end of each main section, and I will take a look if there are any questions, just to ensure that we move along. For those of you with busy calendars, as I know many of us do, I think we're going to target trying to wrap up by 3:30 CET, depending on the number of questions, of course, that are asked, and obviously keen to answer those. So to start off with the TCFD itself and recap a little of where this initiative came from the Financial Stability Board. Getting back to this point that you see on the page from Mark Carney, markets need the right information to seize the opportunities and mitigate the risks that are being created by the transition to a low carbon economy. Clearly, the TCFD doesn't only think about transition risk, but one of the most apparent and driving forces of its inception and creation was this need to better understand where climate risks exist, recognizing the short-term impacts that transitions will have, as well as the short-term need for aggressive climate action. And so that climate action must take place within the existing frameworks of both the financial system and the economy. And in doing so, will create significant potential for disruption of existing businesses, existing ways of powering the economy. And in changing many of these things, there's obviously significant knock-on risks to financial institutions. And so it was with this in mind that the TCFD itself was created near the end of 2015. And in 2017, the first guidance was issued specifically creating this four-pillar framework in order to not only get a sense on what each institution is doing about its climate risk, but also for institutions themselves internally to think about the ways in which they can best address the climate challenge and the degree of preparedness that they themselves see, as well as the degree of preparedness if they are a portfolio company or a borrower, that their lenders or investors are also able to see. So the goal here is really to create a unifying framework, looking at a comprehensive view of an institution and what they're doing, both from the executive level down to the business line, when it comes to climate risks and opportunities. And with that in mind, the TCFD program itself issued a suggestion for 11 different disclosures amongst these four categories. And you can see them here. We'll spend probably more of our time today talking about some of the work that our pilot did around climate scenario analysis, because this continues to be both as stated by the TCFD Secretariat, by a number of regulators, as well as investor groups. The area of scenario analysis and the quantitative expression of climate risks continues to be the area in which the greatest progress needs to be made, and also in many ways is the most important aspect of the disclosure itself. So while disclosures are comprehensive, we probably will spend a disproportionate amount of time focused on the scenario analysis piece, which scenarios we're using, why those matter, as well as on the regulatory side, what some of the latest developments are around climate scenarios and how we tried to incorporate some of that new information into the program. So with that in mind as the overview of the TCFD, the vision here now is to talk about the banking pilot and specifically to cover just some of the overviews that we provided yesterday, but a little bit more of a focus on the transition side, as well as some of the key deliverables. So it's important to recognize that this program really started not just in the summer of 2019, but really had a longer history going back all the way to 2017 and then concluding in 2018 with the publication of this report, Extending Our Horizons on the transition work, as well as Navigating a New Climate on the physical side. The work that was undertaken on that transition side was done with support from Oliver Wyman, and as you know, yesterday on the physical side, from Acclimatize. That work specifically aimed to take the TCFD recommendations that had been issued in 2017 and look at ways that financial institutions could implement those recommendations, and specifically adding focus to how they could produce quantitative outputs for looking at the degree of climate risk experienced. And so what that means is looking at the change in default rates under different scenarios, as well as the associated changes in losses that come from higher default rates, as well as higher losses given default. And so the desired methodology was one that would be both dynamic, scientifically based, and also able to take into account the unique elements of each internal rating system that the participating institutions used. So in this journey, 16 financial institutions undertook this effort of development, and ultimately their findings and that work were chronicled in the Extending Our Horizons report. The second phase of TCFD work, in a lot of ways, aimed to build on the success of that first phase of work, in the sense that it wasn't just about doing a new methodology or coming up with a single enhancement, but really expanding the toolkit overall for financial institutions. And from the UNEP FI perspective, as we see our mandate to help financial institutions play a constructive role in pressing environmental challenges, of which climate is one of the paramount ones, the vision was to expand the program. So we grew from 16 participating institutions to 39. And not only did that increase the geographic footprint, but also the experiences and sectoral knowledge that each participant brought. And in the second phase, the goal was really to use these three pillars of climate scenarios and climate impacts, methodology and data as relates to sectoral assessments, and reporting and governance, in order to put together a program that would leave institutions best equipped to ultimately identify their climate risks, measure their climate risks, and then manage and disclose those climate risks in accordance with the TCFD framework. And so we spent a good amount of time diving into a variety of scenarios with some of the leading scenario modelers, as well as Cicero, one of the leading research institutions on climate scenarios and outputs. We worked on extending the methodologies that we had developed in phase one to look at new sectors, but also to look more deeply at where consensus existed around risk within different sectors and segments. And that was part of our heat mapping exercise. And then finally, in thinking about what is the latest regulatory developments, as well as how does an institution actually practice climate risk management effectively beyond just making the disclosure, but how do we ensure that the TCFD is also an effective framework for informing actions at the institutional level. So it's with those real goals in mind that we set out, and as I've mentioned, this is a preview. Much of the work that we've been concluding over the last couple months will be released relatively shortly. We talked yesterday about the physical risk blueprint. On the transition risk side, we have a series of perspective papers on climate scenarios, how they're being used in the financial sector, that we're writing in conjunction with Cicero. We're also looking at heat mapping exercises and, as I said, a deeper view of climate risk governance and application. As far as carrying the approach from phase 1 forward, we've also developed a web tool that will be open in September to all UNEP FI members, as well as the scenario visualizer that comes with that. We're also in the process of collaborating with the IIF on developing an effective guide and template for disclosure practices, and also internally looking at developing a members-led database to show and share the range of practices observed across our membership and ultimately across the entire financial institution as a valuable resource for you to consider and use in thinking of your own disclosures that you're making. To give a little more color into the timelines and the specifics of when these events will take place and when these releases are, right now we are in the phase of wrapping up most of the work that we're doing. We're also looking actively at those who are interested in joining the next pilot and the next work that we're doing. In early September, we will release the physical risk paper, and then at Climate Week, we will do a release of the transition web tool. We'll see more about that in a moment. And in early October, we'll release the transition risk papers that I just mentioned. And then at our global roundtable on October 14th, we will kick off the next phase of the banking pilot, as well as the investor pilot. And in some ways, a series of those modules will be run in parallel. So we'll talk more about what that'll look like near the end in the what's next section. And finally, the TCFD database that I mentioned, we will release that before the end of the year for member use as well. So now just to go into a little more detail on the specific outputs and deliverables, we have the model that we had worked on with Oliver Wyman, and this is just a brief video visualization. It'll be silent, but it'll be a relatively quick peek into what the tool looks like before it's publicly released to the membership in September. And then I'll talk a little bit more about the database. So to just navigate over to and just setting this up. So just to briefly now just returning to the presentation itself. The one of the other key deliverables that we're eager to share is the database that I was talking about around TCFD practices. The goal here is to really focus on the UNEP FI membership and then ultimately expand to the rest of the financial sector, but to really provide a new degree of color that will go beyond just what you would get in a report from a survey, and really allow you to dynamically play with questions of what types of disclosures are being made, what sort of filters you want to put to look at the region that you're in, to look at your peers, to look at other institutional information that is publicly available. And so this can be a one-stop shop for just understanding what the range of practices you're seeing are, and in some ways using some relatively neat visualizations to make that process easier. So let me stop there and see specifically on the overview if there are any particular questions. One question is around access to the transition check website, and that will be made available. At present, only the public-facing side is open. It's only members of the phase 2 pilots that have access to the back-end piece that enables calculation of transition risk losses. But the goal is, after that release in September, to make that publicly available to all of the UNEP FI membership for free and without a sunset date, for them to use both in visualizing the set of climate scenarios in the tool, which will at that point be nearly 24 of them, but also to run their own analyses across a variety of sectors. I believe that there are 15 sectors and subsectors that are included there. So eager to share that more with you in the coming months. The next piece is really talking about the 3 pillars themselves, and the first of those pillars being around climate impacts and climate scenarios. And so what we had done here was start off with the climate science and spend some time amongst the group exploring some of the specific ways in which the climate changes are likely to impact both institutions, different geographies, and different areas. And starting in that science, we believe, is particularly important for the reason that the climate scenarios that we work with themselves are developed off IPCC climate models, and thus the carbon budgets that are implied, the assumptions and trade-offs that are made around fuel budgets, around switching to different technologies, in a lot of ways flow directly from the science itself. And so understanding that, at least at an introductory level, is particularly important and relevant. So we began with an exploration of not only the evidence that we have that is clear and incontrovertible, that it is human activities that are driving increases in greenhouse gas concentrations, and what impacts that is having and will continue to have on the planet. We then looked at and attempted to expand our minds, not just to direct physical impacts such as rising seas and stronger storms, but also the myriad ways in which impacts are likely to cause problems in society, whether it's in the impact on supply chain, whether it's changes in consumer behaviors, whether there are potential conflicts, recognizing that there's a pretty wide remit of ways in which climate change will influence and impact society, And it's with that in mind that the need for climate action becomes not only urgently apparent, but then we begin to think about some of these key trade-offs. So while some may say this is largely talking about physical impacts, I would argue that it's important to have a strong and solid understanding of the many ways in which climate can impact and influence the human world and the economy before we dive more deeply into what this transition will look like, because in a lot of ways, physical risk and transition risk cannot themselves be wholly separated, but rather flow on a continuum. And so the way that we've explored this within the program is thinking a little bit about, on the right-hand side here, you see relative trade-offs, just generally thinking about whether we take climate action or whether we don't, where we're going to experience more risks, but recognizing that in different regions, based on different actions, whether we're focused more on mitigation or not, the degree of transition risk and the sensitivity of certain industries to that risk is going to vary. And so I think a very helpful way of conceiving of this is a way that has become quite popular in this 2x2 matrix, this one in one of the 2019 releases from the NGFS, explaining that essentially with our climate future, there are a variety of pathways we can take, and the degree of transition risk that is experienced versus physical risk will depend on a couple features, both whether that transition proceeds in an orderly fashion, so whether steps are taken in an assertive, aggressive, but organized way, or whether they're piecemeal and whether they occur in far more of a stop and start or in more of a cascading manner. Also, the way in which physical impacts are likely to drive urgency of climate action and create what the Principles for Responsible Investment, the PRI, talks about as their inevitable policy response. So recognizing that we can't fully de-link physical and transition risk, and that's why we thought as a program it was particularly important, especially in exploring the climate scenarios on the transition and physical side, to get a grounding in the various trade-offs between rapid change economically and worsening physical conditions, and where action may be tipped, where sectors may experience the brunt of these changes, and also what technologies are currently scaling or potentially on the horizon that will have relevance here. And that gets into questions of negative emissions technologies, of scaling various renewables, all things that will have meaningful and measurable impacts on the degree of transition risk. And so with that underline and underpinning, what we then sought to do was really deeply explore these scenarios by looking at a variety of some of the latest models that have been developed on the topic. And so on the transition side, what we looked at were specifically a series of integrated assessment models, and recognizing that these are models that attempt to create a broad economic picture by bringing together physical climate models, bringing together economic and energy systems models, along with questions of land use and other key assumptions, to really get a full-scale picture of how a dynamic future would look and what the changes are that would be wrought under different conditions. So in understanding the mechanics of that, we then were able to look at some of these key factors and key drivers that play a significant role. And in particular, we focused on two main groups of models, one from the Potsdam Institute and one from the International Institute for Applied Systems Analysis, IASA. These are called the message and remind models. And these models are the ones that are specifically used for the most part in the NGFS scenarios, as well as ones that are used in a variety of different climate risk tools, not only including that UNEP FI Oliver Wyman tool that we've just talked about previously, but also in a number of other tools. And I think some of the strengths of these tools and the strengths of these models tend to be their relatively broad and comprehensive view of the wider economy. So you can get some of these interplay effects and ask some really interesting and challenging questions within each of these scenarios. And so in being able to do that, we explored deeply not only the mechanics of these scenarios, but worked pretty closely with the modelers to discuss what the specifics of those scenarios were, and recognizing that each scenario has a particular storyline to it. And within each of those storylines, you have something that is either consonant with your expectations of how things will unfold, is a potential worst case scenario, is a potential base case, and it really depends largely on what those scenarios look like and how those scenarios imply changes in those economic factors, in those energy drivers, in land use practices. And so we were fortunate to not only look at a series of different temperature outcomes, looking at greater than 4 degrees down to 1.5, but also within the specific temperature bands, we were able to look at some specific assumptions, both around low carbon dioxide removal, so decreases in negative emissions. We were able to look at comparing different 2-degree scenarios, and we were also able to speak with the modelers about some of the key assumptions on variables such as price variables, carbon taxes, and others to get a deeper understanding of what specifically these models are doing. And that's particularly important because to the extent that a model is useful and that the scenario it produces is valuable for your analysis, has a great deal to do with the assumptions that that scenario makes. And so there are many ways to reach the same temperature target. I show these pages to make that point that even getting to the same final temperature goal, even using the same carbon budget, you may well follow quite different paths just depending on what assumptions you make around energy mix, around economic growth, around the degree of negative emissions technologies. And all of these things have real implications for how quickly we need to get our emissions down, how quickly various elements within the economy remain relevant and remain sizable. So whether that's the idea of gas as a bridge fuel or moving completely beyond that to a rapid transition that aims to eliminate all forms of fossil fuels, these are going to have major implications on what the transition looks like, as well as which companies are hardest hit. So until we can grasp these differences and understand the nuance of what role these different drivers play, it becomes a challenge to really recognize, how this scenario is particularly distinct from another one. And a lot of the work that we had done, both with the modelers and in exploration, was to really look at some of these key factors in order to not only gain comfort with the models, but also in our assessments, be able to make better views on what different segments were likely to do, given the storyline that was provided and given the assumptions therein. And so I'll stop there just to hear any questions that that folks might have around the scenario work that we did. Clearly, these scenarios then fed into the methodologies and overall approaches that we have, and I'll talk about that momentarily. But I think it was particularly important to explore not just a single scenario, a single temperature target, but really a variety of different ones for the key purpose of ensuring that we both understand what these drivers are, but also think about what their ramifications are when it comes to the different industries and how they're likely to be affected. So with that in mind, as we move from the scenarios, doing this somewhat simultaneously in the program, we moved then into the methodologies and sector analyses, and as I said, I'll just take a question on the scenarios before jumping into that discussion of methodology and sectors. One is the NGFS scenario guide talks about a disorderly transition as delayed 2C with low CDR. What we've received from the modelers at Peak and Yasa are a delayed 2C scenario, and that delayed 2C scenario that they've provided us is a limited CDR scenario. It's not, for those of you who are in the program, I don't think it was stated as such, but this is something we're in the process of confirming with the modelers. But the understanding was that the 2-degree delay as well as the 1.5-degree delay, which the 1.5-degree was only available for the Peak models. On the Yasa side, 1.5-degree delay wasn't something that was solvable under their model parameters, essentially saying that this is not something that model believed was a plausible outcome. And so using the Remind 2-degree delay, I believe we have a lot of similarity, if not the exact same low CDR version. But I think it's also worthwhile for me to just put a finer point on this question of disorderly transition itself, and just to say a little bit more about that, which is what a disorderly transition looks like is quite likely to be the result not just of timing and not just of temperature targets, but also of the ways in which economic actions proceed. And so you can have a scenario that attempts to minimize that disruption by focusing on what is the least cost method of getting to that temperature outcome with that particular start date for climate action. But you can also manipulate the disorderly aspects of the transition by looking at more rapid decreases in certain sectors, more rapid changes that either begin immediately but are focused in a particular sector, usually in fossil fuels, or that happen later but at the same time are ones that are focused on a large quantity of reduction over a short period of time. So there are a variety of ways to create something that is disorderly. The degree to which disorderly scenarios have been taken up by our program really has been focused on the immediate action 1.5-degree scenarios with low CDR, as well as the delayed action scenarios. And obviously, the degree of disorder is going to increase as the climate ambition increases as well, if you keep all of the other parameters the same. So a 1.5-degree scenario will be more disorderly than a 2-degree scenario, all else being equal, just given that the carbon budget is smaller and thus the reductions that need to take place will happen to be more rapid. So after saying that, just to move into what do we do with these pieces of information? What are the implications of this work, and how do we think about this in the context of the loss modeling that we've done, as well as what are some of the collective tools that we've put together as a program in order to provide both greater standardization and deeper understanding for ourselves in doing that. And so the first thing I'll talk about is the underlying methodology that was developed in phase 1 and then extended and enhanced in this current phase of work. And that specifically is the transition risk methodology that starts with these scenarios. So in many ways, the scenarios that we just discussed are key inputs to them, which is why we saw this very much as the second pillar of our work, looking at not just the scenarios now, but how they interplay with the individual institutional portfolios. And so we looked at transition scenarios and what ways their information and their outputs could be transformed or moved into a specific means of understanding and quantifying financial impacts. And at the same time, we thought about what within these storylines would have implications for the idiosyncrasies of various borrowers. So if you think about this, not just at a top-down level in terms of how are decreases in oil demand, how are decreases in the price of a various commodity, or how are changes in overall renewable use, how are those going to affect your portfolio generally? But on the specific level, what about your portfolio is unique and needs to be taken into account at a level that is more granular than just the overarching scenario? And so to do that, we followed this three-step approach of first taking the climate scenarios and transforming them into financially usable information by saying, what do they say across the sectors for a variety of what we called risk factor pathways? And what we mean by those risk factor pathways essentially is, what are the financial pressures exerted by this scenario on a given sector? And so we looked at, on the cost side, questions like, what are the changes in direct emissions costs to a producer? What are the changes to a supply chain, so the indirect emissions costs? What is the need of low carbon capital expenditures in order to produce a sustainable or compliant business? And then finally, how will revenues change as consumer preferences change, or as demand, as indicated by the scenario, changes? And so those were the kind of top-down views. And from there, the goal was, as a group, and we'll talk about the heat map that we've developed, as a group, we then segmented the sectors into specific subsectors, and used those subsectors in order to think about where winners and losers may reside within that sector. So recognizing that even if the model itself doesn't tell us, what is the price of 5 different types of extraction methods, we can still, from the scenario, think about who is going to be hardest hit. So a good example is thinking about direct emissions costs in the oil sector, and recognizing that there's a significant difference of over 50% between the extraction of a barrel of light sweet crude from the Middle East, as well as the versus the extraction of heavier crude, or even going beyond that to tar sand. So recognizing that different areas within a sector are going to be hit differently was the first way of then breaking down the scenario in a way that created something that made intuitive business sense. And then the final step was looking at a series of representative borrowers in order to extrapolate the experience that those borrowers were likely to have, and give a bit more of a specific flavor, specific refinement for the given portfolio in question, give that to the model in order to extrapolate that onto the portfolio. And so recognizing that even if we look at what the scenario variables tell us, even if we break the sectors down into winners and losers, we still recognize that each institution will have a different slate of borrowers. And to take that into account, we use an extrapolation method, essentially extrapolating what the ratings change would be for a few borrowers, and then coupling that with the overarching pressures on the sectors as indicated by the scenarios, in order to produce something that was unique, not just at the segment level, but at the institutional level. And so with that in mind, what we wanted to do was not just this kind of work, but realize that within this framework, there are areas of ability to do greater refinement. One of the most important ones, I believe, is breaking down the sectors further and getting a clear understanding of how different transition drivers are likely to impact and influence those sectors. And so what we did on that front was in the program, we broke into specific working groups on 6 overarching sectors, of which there's a series of subsectors that relate to them. So utilities, we look at utilities and power generation. Agriculture looked at agriculture and land use, both in terms of farming, but also things like fishing and aquaculture. Metals and mining looked at the production of and refinement of various metals, as well as the actual extraction process. But ultimately, relative to which institutions had the most interest in which sectors, we broke them into these groups in order to raise questions and kind of explore the expected sector behavior on a sector by sector basis, rather than trying to think about how the scenarios will impact the entire economy as a whole. And I think in this way, what we were able to do is begin to get a greater degree of knowledge and refinement of what specifically the sector risk drivers were, as well as what the degree of risk that would be experienced by each sector is. And so what we did with that was, at the beginning of the program, once we had broken into these groups, we looked at a variety of different mappings for climate risk that had been put out by groups such as SASB and others. And we also looked at the breakdown that was used in the first phase of work. And then on a sector by sector basis, what we did was we looked at which subsectors are likely to be climate linked, and from there created a bit of a master mapping list for risk identification purposes. And we use that then to say, okay, across the sectors that we're looking at, here are segments that are likely to be climate impacted. Do we believe these segments are comprehensive, and do we believe that they are indeed climate linked? Once we did that, then we began the heat mapping exercise of asking the question of, within the segments that we've now selected, what degree of climate risk is experienced by each? And we use those risk factor pathways that I'd mentioned a couple pages previously of direct emissions, indirect emissions, low carbon capital expenditure, and revenue in order to take these pieces and begin thinking about who is likely to experience greater impacts within these different sectors. So the real goal here was to create a heat map that enabled us to rank order the different segments. And the value of this was, within the process of calibrating the transition risk and the loss outputs, one of the key steps, as I mentioned, is to think about those winners and losers and think about segments for the different sectors and how they would be likely to perform relative to each other. And so as a group, we were able to get together and talk in our working groups about the different behaviors experienced by each segment and their sensitivities to these risk drivers. And here you have an example of what the metals and mining sector would conceivably look like. This is just illustrative, but these were the types of conversations that we were having in order to ultimately produce the heat map that we have produced that will then be released as one of our transition risk outputs. And so we believe the advantage of this heat map will not only be to provide a guide for those in the industry of what we collectively have been thinking about transition risk on a sector by sector basis, but also we believe one of the other advantages is that this can directly be used within the context of the transition model itself. So to further break down sectors into winners and losers, and to do it in a way not just that is idiosyncratic to your institution, but reflects some of the guidance and insights generated within the program. And so these were some of the ways in which we aim to explore sectors more deeply, and also aim to come up with a greater degree of standardization and convergence than the first phase had when it came to questions of expected sector behavior and performance under a variety of circumstances. So let me stop there and just check the questions that we have and see if there's any questions related to the heat map or related to the overall methodology. Obviously, we can go a lot deeper into the methodology in in other conversations. Here, I really wanted to just give a little bit of a taste or an overview of what we're doing, with the idea that this is aiming to be an extension of some of the work that was done in phase 1 in a way that was both more standardized as well as more deeply insightful into the different sectors that we wanted to look at. And so after we looked at the methodologies and previously had looked at the different climate risks and climate scenarios, then another key piece of this is to understand the direction that regulation is going and understand how we can best integrate our work into a comprehensive approach for climate risk, both that meets regulatory demands and it also allows us to be well positioned as institutions to take on the challenge of dealing with climate transition risks. And so one of the things that the program aimed to do was provide briefings on specific regulatory developments, which is particularly important in a rapidly evolving field such as this one. And so we spent quite a good deal of time thinking about developments such as the release of stress testing guidelines by the PRA in the UK, looking at a variety of climate disclosures that have been suggested, and of course also thinking about some of the recent releases from the NGFS, as I talked about previously. One of the things that we had been doing is also thinking about how those NGFS scenarios relate to the guidance that we've been putting together around doing climate scenario analysis. And so we put together a series of briefings and also as the UNEP FI Secretariat spoke with the NGFS to understand how their suggestions and guidance could best be interpreted and then discussed amongst our group. And so, as you can see on the right-hand side, this is one of the most recent releases from the NGFS regarding their climate scenarios. And in addition to this, the guidance that they issued to supervisors around how supervisors should be thinking about climate scenario analysis. And so we believe that staying abreast of these topics is particularly important for the industry and also for our participants. And so one of the key aims of the program was to remain engaged with these regulatory developments, and then of course with developments in the climate scenarios themselves. So as I had briefly mentioned, the climate scenarios that are used by the NGFS, we're speaking with the modelers to just highlight any particular differences, but for the vast majority of the scenarios that have been shared with us, the goal is that they are really the same ones that NGFS is using, and this very much feeds into this objective not only of meeting the regulatory need, but also of building greater standardization across the industry. And so on another topic outside of scenarios, but around specific guidance on TCFD implementation, we've also followed closely with what the TCFD Secretariat is doing and looked at some of the latest developments that the TCFD has undertaken and thought also about how we could constructively play a role in guiding both our participants as well as our peers across the industry in this space. And so not only have we closely liaised with the TCFD Secretariat, but as I mentioned briefly earlier, we've also been working with the Institute for International Finance on developing a guide to help institutions such as those in the program explore what the TCFD implementation looks like, what good practices are, and importantly, in doing this, that work was done in consultation with a variety of the participants in the program and aims to not only show what our good practices are, but also to set a bit of a standard for others in the industry in issuing their own TCFD reports. And recognizing, though, that that the reports themselves are not the end, but rather a overview of what is really going on within the institution. And so the goal of our program is not just to release TCFD reports, but really to implement the TCFD. And so some of the conversations that we've been more recently having within the program, and one of the papers to be released with the transition risk deliverables will cover this, talk specifically about what institutions are doing when it comes to climate risk and what are the specific climate risk applications that we're seeing both at the board level, at this emerging climate risk function, whether it's diffuse or whether it's connected directly to a specific function such as risk or sustainability. And then finally, at the business line itself, what policies and procedures are changing around underwriting and other areas in order to show not just what good climate risk disclosure looks like, but how it can really be implemented and integrated as a risk management framework within the institutions. And so a lot of this work has been very much supported by ongoing conversations, ongoing discussions that we have had as a program. Previously, these were designed to be regional and plenary sessions, as we had had one in London, kindly hosted by the EBRD. And clearly with the pandemic intervening, we have moved these things to a digital format. But in talking about these important questions of how regulatory changes are developing, what the path is on climate risk in a post-COVID world, these are conversations where we believe that the convening power of the UN is particularly valuable and where we're particularly eager to bring our participants together to share ideas and perspectives on these topics. And so one of the things that the program commits to and aims to do in future programs also is really think about what are the ways that we can get the group together to share information. So not just to bring in those outside experts from Peak and YASA, from Cicero, from Acclimatize and Oliver Wyman, but actually to bring together industry practitioners and get them thinking about what good implementation looks like, what the range of practices that they're seeing are. And it's with that view in mind that we kind of look ahead to the next phase of our program and recognize that a lot of this work is not one that kind of ties up neatly, but is a continuation, as one's climate risk practice itself is not something that is done, but something that is an ongoing practice and an ongoing effort to improve. And one of the best ways to do that is through better communication, not only with these key stakeholders that we've talked about, like NGFS and the TCFD Secretariat, but also across the industry itself. And I think one of the nice things about having a group of the size that we had was to really get a variety of perspectives and get a variety of institutions sharing their views on how they incorporate climate risk into BAU, how they're thinking about climate stress testing, what their views are on evolving regulations in their jurisdictions. And these are things that we'll continue to take up in the next phase of work. But in terms of that governance and disclosure pillar, this is one of the areas that I think is most valuable, because this is one where it's not just down to the experts, but really down to the practitioners to push things forward. And we at UNEP FI wanted to and continue to aspire to play a constructive role in bringing people together to have those types of conversations. So I'll stop there now just to see if there are other thoughts or questions regarding this. I see a couple, so I'll take those before we move on to the final point, which is looking ahead to the next phase of work and what those next steps will look like. So one question is on methodologies related to some of the deliverables. The goal is to publish detailed discussion of both how our heat maps were created. The phase 1 report on extending our horizons covers the transition methodology, but the extensions to that methodology and the details of that will be published publicly in our transition risk reports. On the subject of some of the views of evolving governance, and will stress testing be a feature of future program work? Clearly, this is a topic of high importance and one that we're eager to explore as a group. And so I'll talk about in the next section what we're looking to do, both regarding stress testing as well as some other more recent regulatory initiatives and evolution within this climate risk space. So I'll get to that point soon. But given that I didn't see other questions besides those two, I'll move on to our final section of the presentation, talking about phase 3 and where we intend to go with this work from here. So in looking at what's next, I think one of the things that we've laid out in this phase of work that we would aim to continue in the next phase is this desire to help firms begin by identifying their climate risks, then coming up with methodologies for measuring and assessing those climate risks, and then ultimately disclosing and managing those climate risks on an ongoing basis. And so the next phases of work that we have in our future pilots really aim to focus on creating a series of partnerships that will give us the ability to do each of these more effectively. And so on the identification side, this will involve a deepening of our work on climate scenarios. So looking at the broader scenario universe and what that scenario universe implies for both transition and physical risks. On the methodology side, we'll be thinking about questions of integration of physical and transition risks. We'll also be thinking about, on the disclosure and governance side, what a stress testing exercise could look like, what some of the current challenges are to that, and what some of the existing tools, either that have been developed by the program or been developed by third parties, can do in order to help us with that. But we see those as some of the key steps in moving forward in our program. One of the things that we really are excited to do, though, as we continue to broaden the engagement across geographies and across different levels of the kind of TCFD journey, is to really think about how we can develop assessments and disclosures at all levels. And so that means starting with just a basic understanding of climate risk, then getting into that question of how do you identify the physical risks and transition risks, and then moving into questions of climate risk assessment, ultimately into then the disclosures, and then finally into the ongoing management of climate risk. So we see this sort of as a series of steps to build up. And the goal is, with the knowledge and resource base that we've accumulated over time, over the past 2 programs, as well as the investor pilot, taking those resources and enabling someone to plug in at whichever level they're at within their TCFD journey. And so that's one of the goals that we have going forward. As I talked about the 3 pillars in the prior phase of work, we aim to use those 3 pillars again, but in a new way, by looking at a new variety of climate scenarios and looking at using some of the climate scenarios that exist as particularly comparisons across different scenario providers, looking at insights that the NGFS is giving on its scenarios. And then when it comes to methodologies, as I talked about, we'll be looking at a deeper integration of physical and transition risks. We'll be looking at a more comprehensive view, specifically of the variety of hazards that are likely to be be explored and experienced by institutions. And then on the reporting and governance side, the goal is to continue extending the guidance that we provide around good practice for disclosures, as well as for good practice for creating a good and solid TCFD practice, not just in the report itself, but really top to bottom within an institution. So these are some of the areas that we're aiming to develop further within our work. And then in doing so, we also have a few initiatives that we'd want to share more with you right now. And looking at those, one of those is just leveraging, as I've mentioned previously, the convening power of the UN, leveraging that convening power in order to more effectively bring together regulatory stakeholders, climate modelers, financial institutions, and sector experts, both to refine the scenarios that are being used, to ensure that there's a greater understanding of how those scenarios can help in informing views of transition risk, views of physical risk, but also in having an ongoing working group and an ongoing discussion with these key involved parties. And so we continue to want to play that stakeholder role and that convener role. And I think that's going to be one of the main focuses of the next pilot, is bringing those disparate groups together. On a related note, we also want to dive more deeply into particular modules. And by that, I mean recognizing that institutions are at different levels. We want to go deeper into topics that are most of interest to particular institutions. And the way that we think is best to do that is to have an overarching resource library that provides a basic set of knowledge for everyone, that really is a collection of the work that we've done over the past few years, that provides the tools, the trainings, the webinars and insights that have been accumulated. But then at the same time, we provide specific and more nimble modules for participating institutions to go more deeply into areas that are of particular relevance to them. So in that way, we're hoping both to broaden the base of the work that we're doing, but also deepen some of these things by drawing on the resources within this library. So ultimately, these are kind of the views that we have looking ahead to the future of the program, and also the views that we have on how we continue to carry forward this work, especially in an environment where this is an important and rapidly developing issue, and one where we see a need for the financial industry not only to understand the key drivers of these risks, but actually to begin taking clear actions on these topics. And so that's one of the reasons that we feel that the kind of stakeholder convening function is going to be particularly important in this coming phase of the pilot, as well as the ability to go deeper into some of the particular areas. So with that, let me conclude and just see what questions we may have around the next phase of work. Otherwise, we'll wrap up in a few minutes, but just to take a look at the questions that we've seen. One of the questions is around creating an open channel for sharing questions with the modelers themselves. And part of what we are aiming to do in building this stakeholder working group is to have a clear and open communication with them. We have that on a bilateral basis with the Peak and YASA modelers. So we would ask anyone who is in the program who has outstanding questions for the modelers to contact us, because we're keen to ensure that that information is ongoing. But the goal is not just to have that bilateral function in the future, but actually to actively have a group of institutions discussing and working with the modelers to explain how they're using the models, where they feel that there are limitations, what kind of guidance they need to more effectively use them. And so we see our role not just as a facilitator, but really in this convening role. So right now, I would say the best way to connect with the modelers is to reach out, and we'll ensure that the questions that are raised by participating institutions get answered, but going forward, the goal would be to have that be actually a more integrated part of the process overall. So with that, it looks like as far as other questions, I don't see any remaining ones. And so as a result, what I'll say is we're really looking forward to continuing to refine and develop the Phase 3 program. If you're interested in participating in that program, please let me or one of my colleagues know. Another thing to say, though, is we're in the process of developing some of the modules for that work. And so we're quite eager to get your insights on what your institution is most in need of and what your institution is looking to do. And in many cases, that way we can kind of match the models and resources to the needs of these institutions. And so there are a couple more questions, both related to the next phase as well as to some other relevant items. So I'll take those questions before we conclude, but please continue to send in the questions. And if there's something that you wanted to mull over before asking, don't hesitate to send them via email. As I'll note, this session is being recorded, as well the slides will be circulated to all attendees in the next day or so. But as I said, let me just take these two questions. One is specifically around the next phase of work and what the time commitment would look like. Our goal really is to deepen the bank-led and FI-led nature of the programs, and so to have partners that will provide direct value to them, but to have the institutions themselves focused a little bit more tightly on particular topics. So the degree of commitment, I think, will be somewhat variable, but what I would expect is institutions will have access to that core curriculum and then will likely join anywhere from 1 to 2 modules. And in joining those modules, if they're joining one on scenarios, then it's likely having people from a stress testing or risk modeling team as the right people to participate. If it's joining a module that's more on governance, it may be better to have folks from the ESG or sustainability side join, but the goal is to have these programs be driven and pushed forward by the desires of the participants. And so rather than us trying to have everyone cover everything, we want to make all of the resources of the program available to everyone. But the vision as far as time commitment is to find a topic that your institution is most interested in, and then to have commitment to that. And from a sizing perspective, going back to this program, I would expect something on the order of 2 to 4 hours per week for the individual who is kind of the key touch points of the program. Obviously, it's going to depend on how involved the module is, as well as what level of involvement the institution would want. But I think that that's a relatively solid estimate. Another question on these questions of how do we bring together institutions like investors, banks, insurers into one place? How do we have discussions across the industry? And I think that is particularly valuable, and it's one of the reasons that in running the second investor pilot, which will kick off also in the fall, we aim to have more joint modules where there is opportunity for information sharing, particularly on areas where there are clear overlaps, so such as the climate scenarios that are being used, such as insights into sectoral pathways and analyses. And these are all things that I think will have particular relevance for not just the banks, but also for other FIs. Another question I see here is on the profile you'd recommend for the financial institutions participating. At this stage, we've really had such broad participation, both geographically and in terms of the types of financial institutions, that I don't think that there's a particular right or wrong type. But what I would say is the interests of the institutions may be aligned either geographically, may be aligned based on size and exposure of their activities. And my hope is that bringing together some of those similar FIs will be what transpires in the process of putting together the modules. And so while the constituency of the program will be quite diverse, you may end up working then more closely with those who have similar interests and potentially similar needs to you when it comes to some of these particular topics. So as I said, I think that we've covered most of the questions that have been raised. Don't hesitate to reach out. I'm very eager to hear from you if there are particular questions that you still have that we haven't covered, or if you'd like to be more involved over the course of the next pilot as we're beginning to shape this. So if you'd like to either provide some feedback or thoughts on what would be useful for you and your institution, I think that'll be really terrific. Also, if you'd just be interested in joining us in the coming months, both for the release of the physical risk reports, as well as the transition tool and the transition reports, we would love to have you join those to see those public releases as well. And so the last thing I'll say is just also a big thank you to the participating institutions, the 39 that have been in this program thus far, because I think they've not only provided a lot of their time, enthusiasm, and energy, but really have helped move the overall discourse forward in the industry through the insights they've generated and through the work that they've been doing with us. So I'm really proud to be working with them and really eager to work with many of them in the future on the next phase of work. So just wanted to give a big thank you before we wrap up. And as I said, I figured we would end a little bit early, just given the amount of content to cover and the range of questions. But as I said, don't hesitate to reach out if you would like to speak further about these topics, or if you have any particular questions about our TCFD programs overall. And so with that, I will stop the recording and just say to the rest of the group, a big thank you for joining us today. And we're eager to continue the conversation in the ensuing month.